Good. Now we're going to have a look at the elements of financial statements. And we've spoken about this very briefly before, and we said that the elements, that is assets, liabilities, equity, income, and expenses. Now the conceptual framework tells us when is an element an asset, when is an element a liability. And you must be able to know the definition criteria and again to apply that in certain scenarios. Now, an asset. The definition of an asset is it's an economic resource controlled by the entity as a result of past events. Economic resource controlled by the entity as a result of past events. Now, what is the economic resource? Now, the conceptual framework goes along and it actually defines an economic resource for us as well. So when you are talking about this definition of an asset, you cannot stop here and say it's an economic resource, because then you have to drill down further and say, well, an economic resource is a resource that has the right, that has the potential to produce economic benefits. And then we will go further and we will talk about what is a right. And here it's very important that you see it has a potential. So it's not to say that it is certain it's going to have certain economic benefits at the end of the day, but it must have the potential to have. Now let's have a look what is a right. It is a right, can be a right to receive cash. So if you think about a debtor, the entity has the right to receive the outstanding amount, cash, i.e., from the debtor when he pays his outstanding account. So therefore, a debtor is an economic resource, is a right, so they will have the right to receive the cash from the debtor, and the potential economic benefits is that once they're going to receive the cash, their own cash resources is going to improve with that amount of money. A right can also be the right to receive goods or services. Let's say, for instance, that we have a bad actor and you have a tractor. You want my backed actor and I want your tractor. So we go into some kind of transaction whereby I trade my back actor for your tractor. Am I going to receive cash? No. Am I going to receive goods or services? Yes. So there's a right to receive goods or services. And this is not and or. There's a right can be either one of these things. A right can also be a benefit from an obligation of another party to transfer economic resources if an uncertain, specified future event occurs. Rights to benefit from an obligation of another party to transfer economic resources if an uncertain, specified future event occurs. My entity purchases a new machine for our plant. According to our purchase agreement, the supplier of the machine has to grant a guarantee over that machine, working off the machine for the next 12 months. If that machine breaks down within the first 12 months after the purchase date, the company has the right to exchange that machine for a new machine. So they must come and replace that machine then. So listen now carefully. We have the right to benefit from an obligation of another party. So the supplier has the obligation to transfer an economic resource, a new machine, if an uncertain specified future event occurs, if our machine breaks down within the first 12 months after the purchase date. A right can also be over physical objects such as property, plant, equipment, inventory, etc. So I have a right to occupy a building. It's my building. I have the right to use my plant, equipment, inventory, whatever, for the purpose that I deem fit. The rights to use intellectual property. I have very clever persons that's working for me. we are developing a new vaccine for COVID-19. So that patent, that recipe, if you want to, for the vaccine, that is being developed by my company's intellectual property. So the people who's working on that is the intellectual property of my entity. So an economic resource is a right that has the potential to produce economic benefits. Now, what is potential to produce economic benefits? It does not mean that it is certain or likely that the right will reduce economic benefits. The right must just exist and in one possible circumstance produce the entity economic benefits beyond those available to any other party. So I am the chosen one. I am the one that's going to receive something that nobody else is going to receive. So if this machine that I've bought is going to pack up within the 12 months, he's not going to replace all the machines sold to everybody that has bought the machine in this purchase period. He's only going to replace my machine. So and it is only going to happen in a possible circumstance when that machine is going to be packed up and I cannot use it anymore. What does control means? Now that is important. Control means it links an economic resource to an entity. So the entity controls that economic resource. Now what does that mean? That means the entity has the ability to direct the use of the economic resource and the entity has the right of obtaining the economic benefits that flow from it. That machine is in my plant. I can decide when I switch the machine on and when I switch the machine off. That machine is going to manufacture some kind of product. I'm going to sell that product, so I'm going to receive the economic benefits that flow from it. I have the ability to direct the use of the economic resource. I can switch it on and off if I want to, and I'm going to use the proceeds from those products that I'm going to manufacture out of that machine that is going to be mine. The entity has the ability to enforce legal rights over the resource. You cannot come and take my machine anytime you want to. It's my legally owned machine. It belongs to me, so you cannot decide. The entity will either directly or indirectly receive the economic benefits arising from the use of the resource. I'm going to directly receive the benefits from selling the goods that I'm going to manufacture with my machine. Now there is something that's very important in accounting. Now remember guys, when I buy my fancy BMW 5678 III 677 with a simple dot on what have you for $2 million, it is not your car until the date that you have fully paid back the bank the outstanding amount on the car. It is only once you've paid the last cent on your installment agreement with the bank that that car will become legally yours. So now the question arises, if that is my car, can I really call it an asset of mine? Now there is something that we call substance over form in accounting. Substance over form. And the long and the short of substance over form is, they say, well, who is controlling the car? Who decides when I'm going to drive with the car? Who's going to drive the car? How long are you going to drive with the car? Me. Who is going to put in the fuel into the tank of the car? Me. Who's going to pay for the fuel? Me. Who's going to pay for the service of that fancy BMW car of mine? Me. So basically, what I'm telling you is that all the risks and rewards of ownership of the car is already with me. I control the car, I decide what can happen to the car, I maintain the car, I keep the car on the road. Out of a legal perspective, it is not my car yet because I haven't repaid everything. But then substance over form says the form of this contract is as such that although It is legally not yours. The substance says that you are the owner, and therefore you must recognize that BMW in your statement of financial position as an asset. So let's read here. Substance of contracts. To represent contractual rights and obligations faithfully, financial statements must report their substance and not their form. So therefore, substance over form. In some cases, the substance of such rights and obligations is clear from a contract's legal form. But in other cases, the terms of the contract or a group of or series of contracts may require analysis to identify the substance of the rights and obligations. Now, again, go to your textbook. There's also a nice discussion on substance over form in your textbook. And there you will see that the legal form of a transaction is not necessarily the accounting substance, the essence of the transaction. So out of an accounting perspective, we will follow substance. The fact that you control the asset, the fact that you use the asset, the fact that all the risk and reward surrounding the asset is already been transferred to you. Therefore, out of an accounting perspective, you act as the owner of that asset, and therefore you can recognize that asset as an asset in your statement of financial position. So substance over form is all about the substance of the transaction and not the legal form of the transaction. Very important. Okay, let's start with cons. Liabilities. What is the definition of a liability? A liability is a present obligation of an entity to transfer an economic resource as a result of past events. Now again, we have to break it down a little further and see what does present obligation means. Now, obligation is a duty or responsibility that the entity has no practical ability to avoid. Those are very important words. The entity has no practical ability to avoid that responsibility to honor the obligation. Now, many obligations are being established by contract or legislation and is legally enforceable by the parties to whom they are owned. So guys, in short, when there's a contract, when there's a legally valid arrangement made by two parties or more parties, then it means that thing is legally enforceable. And you cannot, out of a practical point of view, avoid to meet your obligations according to that contract. Now, in order to transfer the obligation, there must only be a probability that the economic resource will be transferred. So it is a present obligation of the entity. Present means it exists now to transfer an economic resource. Now, it's not to say that that economic resource is going to be transferred there, but there must be a probability that that legal resource is going to be transferred, and then as a result of past events. Obligations to transfer an economic resource. Obligations to transfer an economic resource may include obligations to pay cash. If I've borrowed money from the bank, I have to repay them, that loan amount. And how am I going to repay them? By giving them cash. Obligations to provide goods or services. We have agreed that we're going to enter into a trade transaction. I'm going to give you my back actor. You are going to give me your tractor. So I have obligation to provide the back actor once you have provided the tractor. Obligations to transfer an economic resource if a specified uncertain future event occurs. Now, what they say here is we have to transfer an economic resource, like a guarantee, for instance. Once that thing that we have guaranteed is going to break down, and we have undertaken, we have given the guarantee, we have to perform under the guarantee. So that means that that is an obligation to transfer an economic resource, but it is uncertain whether the event will occur under which I'm going to perform. Now, obligations to transfer an economic resource may include also if there's a duty or responsibility that arises from the entity's customary practices, published policies, or specific statements. The entity has an obligation if it has no practical ability to act in a manner inconsistent with those practices, policies, or statements. Now, that's a very long paragraph. Let me give you an example of that. I have a company now for the past 5 years. Every year since I've started off with a company, in December, I have paid Christmas bonuses to my staff without any exceptions. Now, guys, nowhere in an employee's contract is stipulated that they will receive a Christmas bonus. But for the past 5 years, I've paid the Christmas bonuses. I'm a good person, and I've decided that they should get a bonus. Year 6 come, and I suddenly decide I'm not going to pay a bonus anymore because I want to go overseas, and I don't have enough cash to pay Christmas bonuses as well as paying for my overseas holiday. And this year, I do not pay a Christmas bonus to my employees. Now, according to this thing, they say that I have an obligation to pay that Christmas bonus because my responsibility arose from practices from the past. I have every year since inception paid a Christmas bonus. There is really no valid reason why I should not pay that bonus this year. Holiday is definitely not a valid reason. Therefore, my practices in the past has actually created the obligation to pay the Christmas bonuses this year as well. Equity. What is equity? Equity is the residual interest in the assets of an entity after deducting all its liabilities. All of you know the old accounting equation, right? Equity equals assets less liability. The residual interest after the assets, after the liabilities was deducted from the assets. Equity is thus dependent on the amount of assets and the amount of liabilities and not the market value of an entity fair. So that is what's actually lying on the statement of financial position. The asset value in the statement of financial position less the liability value in the statement of financial position. The market value of what the company shares is trading at is completely something that's happened out there. It's got no impact on the statement of financial position. Now, equity is subdivided into contributions of owners, so capital, and then any retained earnings and reserves. Now, retained earnings means that is profits that the entity has made in the past, but which was not distributed to the owners in the past. So it's still lying there. It was capitalized, it's part of equity, and that is, well, it formed part of equity. What is income? What's the definition of income? Now, income is an increase in assets or a decrease in liabilities that result in an increase in equity other than those relating from contributions from the holders of equity claims. Who are the holders of equity claims? The owners of the entity. Now, let's read this now very carefully. An increase in assets. Now, assets got a debit balance. So if an asset increases, I have to debit the assets. And then what am I going to credit? Probably income. A liability's got a credit balance. So if I decrease a liability, I have a debit that liability account. So what am I need a credit entry somewhere. Probably going to be income. He says, but this only apply that if it is not a transaction done with the holder or the owner of the entity. Now, income is divided into two things again. The one is revenue and the other one is gains. Now, what's the distinction between the two? Revenue arises from normal business activities. I buy shoes and I sell shoes. That is sales revenue. Sales revenue is when I sell it and I receive money for that, and the cost of sales was the purchase price of the shoes, the cost price of the shoes. Normal business activities, that is revenue. Now, what is a gain then? A gain says, well, it meets the requirements of a definition of income, but it is not necessarily that it arises out of the normal way of doing business. Let me give you an example. I had a delivery vehicle. I've sold my delivery vehicle. I made a profit on the disposal of the delivery vehicle. Is that a type of transaction that I normally do? Is it part of my normal business activities? No. It's the first time ever in my life that I've bought a delivery vehicle and sold it after 3 years or 4 years. So that profit on the disposal of the vehicle, that isn't revenue, that is a gain. It means that I've made a profit out of something which does not arise out of a normal business activity. Expenses. What is the definition of expenses? Expenses is a decrease in assets or increase in liabilities. If an asset decreases, I have to credit the asset, so the debit should be an expense. Or an increase in liabilities. So if your liability increases, I credit the liability, so there's a debit hanging around somewhere, and probably that is an expense. That results in a decrease in equity, other than those relating to distributions to holders of equity claims. So other than those relating to payments paid to the holders or the shareholders or the owners of a company, of an entity. If it's a one-man band, what kind of distributions will I make to the owner? Withdrawals. He's going to make it himself. So then that is a distribution. So that is not an expense. Here, very specifically, drawings are excluded. Why? Because it's a distribution to the holder of capital in that entity. So a decrease in assets or increase in liabilities that result in a decrease in equity. Expenses makes equity less. Now that includes losses as well as those expenses arising in the normal course of ordinary activities. Income and expenses represent changes in economic resources and claims, reflecting in the financial performance of the entity. The financial performance of the entity is reflected in the statement of profit or loss and other comprehensive income. Now guys, we have now run through all the definition criteria of an asset, a liability, an income, and expense. So that is the first test that you have to apply. So if this item that you're working with actually fulfills or adheres to the definition criteria of either one of those elements, you've put it in that little box and you've ticked that whole box and you say, well, this item is for sure an asset. It meets all the definition criteria of an asset. That still doesn't mean that I can show that asset in my books. The next step is whether that element adheres to the recognition criteria. So it is only if it adheres to the definition criteria as well as the recognition criteria that I can recognize an element in the financial statements. So we say that process of capturing for inclusion in the statement of financial position or the statement of profit or loss and other comprehensive income, an item has to meet, number one, the definition of that element in asset, liability, equity, income, or expense, as well as the recognition criteria. Now, if we tick the first box and we say, well, this asset, for instance, meets the definition criteria, then we will go along and we're going to measure that to the recognition criteria. Now, recognition is appropriate if it results in both relevant information about the element, asset, liability, equity, income, and expenses, as well as a faithful presentation of those items so that we can provide useful information to the users of that financial statements. So the recognition criteria, tick box number one, did it meet the definition criteria, recognition criteria, did it meet the definition criteria of that element? And then we're going to test it both for relevance and faithful presentation. Now, I will come back to this, but I want to show you this. Relevance. Now guys, relevance is about two things. The first thing that is important under relevance is the certainty that that element exists. So it is all about the certainty whether that element, asset, liability, income, expenses, or equity exists. And then the second thing under relevance is the probability that there would be a flow of economic resources somewhere in the future. So that is what relevance is all about. Faithful presentation is about the certainty or the uncertainty surrounding the measurement of that item, that element. So whenever you're going to discuss something, let's say that I give you a scenario, you have now decided that this is the asset. You've written down the definition criteria of the asset. It meets all the definition criteria of the asset. You're going to go along and say, okay, well, now we're going to test for recognition criteria. You say the first box I've ticked because it meets all the definition criteria. It says, now I'm going to go along and I have to tick boxes 2 and 3, which also forms part of the recognition criteria. Box 2 is I have to check for relevance. Under relevance, I want to check for two things. Number 1, is there any uncertainty about the existence of this element? Number 2, is there any uncertainty about the flow of economic resources? Can be, depending what it is, if it's the assets, it's an inflow. If it's a liability, it's an outflow of economic resources. So is there any uncertainty about the flow of economic resources? So if I have now measured that element on those two uncertainty levels, I can then move along and let's say, now we can check for faithful presentation. And under faithful presentation, we are going to check for the uncertainty about the measurement, i.e. the value of that element that we want to recognize. Now, if there's no uncertainty about the measurement of that element, and there's no uncertainty about the existence as well as the flow of economic resources, and it meets the definition criteria of that element, then and only then may I recognize an element in the financial statements. So we can summarize that in a little box, and we say relevance is whether recognition of an item results in relevant information that may be affected by the low probability of the flow of economic benefits and existence uncertainty. And then in the other box, the next tick box is faithful presentation, where the recognition of an item results in a faithful representation, and that is affected by measurement uncertainty, recognition inconsistency, and it will have a direct impact on the presentation and the disclosure of the item that I'm going to show. Now, similarly, as there is things like we call recognition criteria, there's also something that we call derecognition criteria. So when do we stop recognizing an element or a portion or a part of an element in an entity's financial statements? Now, when does derecognition normally occurs? Now, if we're talking about an asset, derecognition will occur when we lose control of all or a part of the recognized asset. We had the delivery vehicle, we sold the delivery vehicle. When did we lose control over the delivery vehicle? The date that we've sold the vehicle. So when do we have to derecognize that vehicle in our books? At the date that we've sold the vehicle. So when did we lose control? The date of sale. When didn't it become our vehicle anymore? When did we lose control? At the date of sale. So at that date, we're going to derecognize that asset in our books. If we talk about derecognizing of liabilities, that will be when the entity no longer has a present obligation for all or part of the recognized liability. We bought our fancy BMW XIZ 945 WI, whatever exclamation mark BMW. We paid the last cent to the bank. on our installment sale agreement. Do we have any obligations yet to pay anything to the bank? So that outstanding loan, is there any amounts left of that outstanding loan? No, because we no longer have a present obligation to repay the bank anything. So there's no obligation anymore. And what is the date of derecognition for the liability? The date that we've repaid that last cent on the loan. Now, derecognition aims to faithfully represent both any assets and liabilities retained after the transaction that led to the derecognition and the change in the entity's assets and liabilities as a result of the transaction. So, remember, we don't necessarily have to sell or derecognize the full asset. It is also possible that we can only derecognize some of the asset or some of the liability. We have a bank loan. We have repaid half of the bank loan. So what do we have to derecognize? 50% of the outstanding liability. So we haven't settled the full obligation as yet. We only settled a part of the obligation as yet. We had a piece of land, property. We subdivided that land and we've sold half of that land after the subdivision was approved. So we have derecognized part of the land. We don't have that full property, 5,000 square meters anymore. We only have 2,500 square meters left. So we derecognized half of the property. At what date? When we sold that piece of land to another party. So we don't have it anymore, so we have to derecognize that portion of the land. Good, then the conceptual framework also goes on about the concepts of capital and capital maintenance. Now, the only thing that you have to know about this is that there are two concepts of capital. One being the financial concept of capital, and that is what we are working with. And the other one is the physical concept of capital, and that probably is what you're going to do in MAC when you do management accounting. So financial concept of capital is capital or equity is equal to the net assets or the equity of a company. What is net assets? Assets less liabilities. What is the physical concept of capital? Capital is equal to the production capacity of an entity. So this is all about the infrastructure that the company has in order to earn money. So if my infrastructure, my production capacity, my machinery is getting old, I have to have a healthy capital maintenance program in place where I am on a regular basis have to replace old machinery to make sure that my production capacity is not impaired and that I can maintain or even increase my production capacity as well as my profitability over time. Guys, this is very important, and here I'm also going to refer you back to your textbook. There is very nice examples in your textbook. They actually discuss this very, very clearly. What is the difference between all these measurement bases that we are allowed to use according to the conceptual framework? You have to be able to give me the definition of each and every one, and you have to be able to talk about that, and you have to be able to actually discuss that in a question. Now, the one that you are familiar with coming from school is the historical cost concept. And very much in this year, we're still going to apply the historical cost concept. But going from next year forward, you are going to use the current value approach more and more and more, because in the IFRS statements, that is the way that accounting has developed over time. So what do we mean by current value? Now, under current value, we have fair value, value in use if it's an asset, or fulfillment value if it's a liability, and current cost. Now, if we talk about fair value, we say, well, we have a piece of machinery. Out of this machinery, we can potentially earn year 1, 100,000 Rand, year 2, 200,000 Rand, year 3, 400,000 Rand. But remember, 400,000 Rand in 3 years' time is not worth 400,000 Rand now. So therefore, we have to discount that potential cash flows into terms which is going to be reflected in today's rand value terms. So that is fair value. I look at the potential cash flow that I can earn out of an asset if it's an asset, and I'm discounting it back into their present value, and that is the value of the asset. I can also use value in use. Fair value, also if it's a liability, I look at all my commitments that has to be serviced over the next couple of years. I present value all those commitments back into today's terms, and that is the value of my commitment. If we go to the next one, value in use, if it's an asset, I say, well, this asset can be used and the value I'm going to get out of it is X amount. Or fulfillment value, if you look at a liability, we say, well, all the amounts that I have to pay for this liability, that is the amount, and then that is our value in use and our fulfillment value. Current cost says, I'm going to look at a similar asset with a similar lifetime and what it's trading at today's values out there in the marketplace. So I'm really going to look at the market value of a similar type of asset, and that is going to be the current cost of that asset. So please, and I urge you to work through your textbook, make sure that you know the differences between these measurement bases and that you can talk about that. And 2-3 years ago, we had an exam question that actually was all about the measurement of elements. Okay, then I have an example, for instance, how you're going to go about in order to answer this type of questions. On 28 December, company accounted for an invoice received from the municipality relating to electricity usage of 1,500 rand. The company's year end is 31 December. Bank statements indicate that the electronic payment of the account occurred on 10 January 2012 of the next year. Discuss whether the company may recognize the transaction in 2011, so for the financial year ending on 31 December 2011, in terms of the conceptual framework. So it's a very simple example. It's my telephone account or my municipality account. I've used all the services in December. I only received the account at the end of December, and payment for that account only took place on 10 January. The question is whether that expense must be recognized in the financial year ending 31 December 2011. Whoops. Yeah. Now, we all know it's all about expenses. So you must be able to identify that at least, that this municipal bill is all about expenses. So what you're going to do is you're going to jot down the definition of an expense. A definition of an expense is a decrease in asset or increase in liabilities that result in a decrease of equity other than those relating to distributions to holders of equity and claims. So the definition on the one side. The application of that is, although the services was rendered in December, payment hasn't taken place yet, therefore there's a present obligation to pay for it. Liabilities will increase as a result of such an obligation. So the first one said there must be a decrease in assets, which is not the case, but there will definitely be an increase in liabilities because I have a present obligation to pay my municipal bill. That results in a decrease in equity. When payment is going to be made, the net asset value will decrease because I'm going to pay cash, so my cash resources will be reduced. Therefore, equity will decrease once I'm going to pay my liability. Other than those relating to distributions to the holder of equity claims, the payment will be made to the municipality and it will not be made by the owners of the entity. If we talk about the liability at year end, it's a present obligation of the entity to transfer an economic resource as a result of past event. Now, a present obligation, the entity has used the electricity and is legally obliged. So there's an unavoidable obligation that the entity has to pay for the service that they've used. To transfer an economic resource is a right that has the potential to produce economic benefits. The economic resource that will be transferred is the amount that will be paid for electricity, which will reduce the cash resources of the entity. As a result of past events, and the past events was the electricity that was used in December. Then the recognition criteria. Now that is all about relevance and faithful presentation. Relevance, we said, is all about the existence of the element. the uncertainty about the existence and the uncertainty surrounding the flow of economic resources. The cost was incurred, no uncertainty. In the current financial year, no uncertainty, and it must therefore be recorded in the financial records of the accounting period under review. So there's no uncertainty that I have to pay for it also in the future. It actually should have been added here. The flow of economic resources that needs to take place is the payment that's going to happen, in January. Faithful presentation, we said it's about the measurement uncertainty. So as the amount, is there any uncertainty? There's no uncertainty. We've already, as a matter of fact, received the invoice and we know exactly what is the amount that we need to pay. And then we will have a conclusion. The transaction complies with the definition of an expense as a liability as at 31 December. In accordance with the concept of accrual accounting, the conceptual framework requires that the expense and the liability must be recognized in 2011 financial year. Therefore, an expense in the statement of profit or loss and a liability credited in the statement of financial position are recognized.